All right, good morning, guys. Welcome to the Flip Texas podcast. I am super excited to be here with my good friend and financial mentor, Pete Underwood. Thanks for coming on, Pete. Appreciate it.
Thank
Pete
you.
has actually done millions of dollars in loans for us and has a lot of money out on the street backed by real estate right now. So he is a very important person to listen to with what's going on in the market. He's seen a little bit of the good, bad, and ugly. So y'all definitely should take notes from this and look forward to it.
Sounds
What's
good.
going on, Pete? How are you today?
Good. Just working through lots of deals and trying to figure out where this market's going.
Okay. So you're still figuring it out as well.
Well, I think I know where it's going. I think we're going to be definitely seeing slowdowns, higher days on markets, that sort of thing. But I don't have a crystal ball. If I did, I wouldn't say it here. But I think it's a time to be conservative.
Okay.
In this market, that's probably the way I'd put it.
Okay, so you're not the bearer of bad news right now, but you're saying, hey, let's.
I would just say, make sure you have liquidity. Don't push the limits on anything, because with the rates rising, and other things, there's a lot of headwinds in the market with respect to housing prices. There's some tailwinds, particularly in this state, from the standpoint of lots of people moving here still, from higher cost states to lower cost states. That helps, but the major headwinds are 10 or more percent inflation, depending on if you really believe what the government says, and then rising interest rates, of course, will put affordability down.
Okay.
And we can go into that math if you want now, or we can wait till later.
Sure. I mean, whatever you want to talk about first. I mean, I know we could chit chat here for forever. I know you have certain things that you're really passionate about as well, like things not to do. I have here that we were chatting earlier about, like what can go wrong. I know you said like bad partnerships. Do you want to
let's start with common mistakes of flippers. I think there are several different mistakes flippers make. Since we're starting off a little bit negative, what we see when loans go bad or hit a little bump in the road, bad partnerships is definitely one of them. And what I mean by that, typically when you get into a partner, there's a financial partner and an operating partner. Operating partner is the flipper. Maybe they're both operating partners, and one guy is just helping the other guy out with money. But what I've seen in this business is partnerships are really not well defined. And what I mean by that is you enter in a deal with just financial split, i.e. somebody puts up the capital, makes X percent of the return, and the other guy does the work. That's all good, but that's kind of missing the protections. And usually they're oral or handshake agreements. I think the better way to approach it, and you can probably find examples of this just Googling them on the internet, is to make sure that that needs to be defined, but also who has what responsibility. A lot of times the financial partner will want to get into flipping on their own. They're like, I'm going to help you out. And the operating partner kind of says, I've got 10 other flips going on, or however many other flips, and kind of leans on that person. And then it's like the old drop ball in the outfield sort of thing. Both outfielders are out there.
He said, she said.
Well,
we didn't have anything written down.
Well, I'm just thinking someone's supposed to do something, the other person thinks that person's supposed to do something, and you got two outfielders looking there and the ball drops in between them. And then you just push out the time, and as we talked earlier, time is the enemy of this business. So that's problem number one with partnerships without having a defined roles. But the big thing is, what happens if things go bad? What are the penalties to each party? Okay. Right? And so I think that I've seen it happen multiple times where there were no penalties, and the financial partner banks on something happening there. Doesn't have the money that they claim.
Are they both signing?
You both sign a partnership,
a personal guarantee on this debt.
Okay, so
I know we're getting a little
taking it to my perspective. Yes, I want every partner. I can't fully.
Ideally, every partner you know about.
Yeah, exactly. I can't fully I don't always won't always know if you bring in a partner. I wish I would, but because then that actually helps the flipper. It may reduce their percent of the profit share, because if I'm a financial partner and I say now I'm signing the debt, I personally would want more of the income because I'm on the hook for the debt, right?
Mm-hmm.
So I'm giving something up. I'm hurting my debt capacity to do other things. If you're the financial partner. Okay. So, but from where were we? From things go bad, penalties, right? I've seen it where a lot of times each partner doesn't do enough diligence on the other partner, especially the operating partner and the financial partner. And so the financial partner comes in and says, hey, I'll be your backer. And the operating partner says, all right, sounds great. Shake a deal, move on, right? And we go do the deal. Problem is do you know how much money that person has? Do you know if they can afford the liquidity?
I got a call from a commercial property owner called me. I'm sorry, it was was it last night I was on the phone, and I had a lead from social media, and it was a guy with a commercial property, about 15,000, about 13,000 square foot, just outside, in Wharton County. And they were like, hey, I was told by my brother that to not work, they had a balloon payment coming up. They bought it owner financed.
Okay.
They bought the property owner financed, and they had a balloon coming up in some amount of time. And they're like, hey, don't worry about it. We'll partner up and I'll buy it whenever this is done. And basically, so that person didn't worry about the balloon until there became an issue. And it didn't work out. Yeah.
Well, my thought is, and I've seen this happen, is either they didn't do the diligence, didn't say, hey, well, show me the proof of funds, right? Show me that you have the money. Now they can go spend that money, so it's not foolproof, right? But if they don't have the money to pay the interest with some cushion, to fund the rehab before you get refunded by your lender, things are going to go bad. And if you're banking on an event to happen, i.e. this person has a house to sell or a refi, that can put everyone in a bind. And if there's no penalties, I mean, you can sue them for some breach, but there should be some financial penalties. If it's a handshake deal, what are you going to do?
It wasn't clearly laid out.
If it's a handshake deal, what are you going to do? He didn't breach any contract. So
we're both on the LLC.
So if you're both on LLC, helps. If you're both on the debt document, the promissory note, that helps, because now the lender can come after you both. So therefore, he or she, the financial partner, is kind of on the hook. It'll help you to have them on there, but defining the roles, the penalties, the economic split in partnerships, I think is very important. And I'm sure there's plenty of precedents out there that can be used for this stuff, but handshake agreements, even if they're your buddies, I'm sure you've probably done one. I'm thinking of, but it's to be careful.
We have a loan with you now where we have a J. So I never do any deals anymore with anyone unless it's clearly defined. This is the roles and responsibilities this person's doing.
Good.
So we have a deal with you right now.
I know which one you're talking about.
We have the JV agreement, and it's like, hey, this person's doing this. This person's
doing
line by line. And whenever anything comes up, we're going to refer back to the agreement.
Okay.
It
protects both people.
Even if you're friends or family, it's like you're doing a service to each person by putting that in writing.
It is. It's the good fences make good neighbors type of thing, or whatever the saying is, but it's the exact same thing, and it protects both parties. Mm-hmm. Just like the promissory note that you sign with me, it protects you, and it protects me. It's not a bad thing, right? There's things that it says that I will do, and things that says that you will do, and it's defined. The one we use is a State Bar Association promissory note. It's very defined. It's been fought in court, I'm sure. So it's the same concept with the partnership agreement. So that's one where I see, if I think about the foreclosures that I've done, very few foreclosures, and less than 1% over the course of the last 5 years, probably 1/3%. It's less than a handful, or I count them on one hand. It's usually somewhere around bad partnerships. I think the other big one I see is going from, or another big one on where flippers make mistakes is stepping up in value. So they're typically flipping, 300-400, maybe 100, somewhere in that range, $1,000 homes, and then they always step up into luxury. And it's a different ball game for several.
I want to make more money, Pete.
for fewer houses, right? You're right. But
Okay.
the problem is, is fewer buyers up there. But really, on the flip side is the flippers try to use the same contractors, the same finishes. There's a tendency to do that, and that buyer, the luxury home buyer, which is now $1 million in Houston. A few months ago it was $750. That was largely the price point where they call luxury. It's just more discerning and more. They're pickier. Houses move slower at that level, generally speaking. So the flipper underestimates the repair cost, the finish level, days on market, the HOAs in those neighborhoods. I have flipped in.
I like how you call them.
Yeah, I have flipped in some expensive neighborhoods, Memorial, to be one. They were not good projects. I lost.
Those are the neighbors. Those are the
neighbors that'll call you out.
Those are the neighbors that call. Yeah,
They're the neighbors that call, and the HOAs are all over the
HOA.
place. Yep. And so, and a lot of
they get you stopped. I have a question for you in general as well. And I have friends tell me this, and I have friends tell me that. My personal opinion is if you're doing a lot of work and you're not always pulling permits from the city, I think you haven't done that many deals if you said you've never got a red tag by the city. But I'm curious, and you probably don't always know. We've had multiple projects with you that have got red tagged by the city. That Freeport one we just closed on got red tagged. And I'm like, Freeport?
Yeah.
Are you serious? This is like where I would least expect it, because usually in the more dilapidated areas they're not usually as tough out there. But we already
cleared it.
We already cleared it. Because we've been through this process so many times. But it costs more with when you have to get the engineer out there. But
slows everything down.
What percentage of investors do you think
pull
are
permits?
Getting red tagged, and do you think that causes issues for some of them? Because in my opinion, that's one of the worst things that can happen to a new investor.
Yeah, and so a new investor probably shouldn't be taking on projects that have that potential. So stick with the cosmetics, because if it's inside the house and you're not moving a bunch of walls, you're not doing a lot of plumbing stuff, if I was going to dip my toes in this as a new flipper, I would try to just do the easy stuff first, and then work your way into more complex projects. So, as far as what percentage of red tag, oh man, I have no clue, because I know sometimes I find out and it's fine. It's not the end of the world. I have a couple I can think off the top of my head that are red tag, and I knew that. I can tell there's a problem when I have a repair budget that's just sitting there and it hasn't moved in several months, and that could be a number of problems, but one of that could be red tag. So, and then I'll generally I'll have someone call the bar and say, hey, what's going on? Is there any way we can help you guys? Or, and it could be a number of things, but it also alerts me to potential problems down the road. But I don't have a guesstimate. I would say 10% or less.
Okay. So you're telling me that it sounds like you recommend a lower repair budget for somebody who's just starting out. So like, I have a good friend, and she wants to get into flipping. She doesn't have she has some contractors that she could find, but she's not super experienced in the rehabbing part. So I know I've done a couple townhouse remodels where those are that's an interesting class.
Yep.
There's pros and cons to it, but one of the pros I think is like it's not a huge area to remodel. It's
correct,
pretty simple.
Smaller.
Let's do a couple bathrooms. Let's do some flooring. Let's do some paint. Let's put some granite in, and you're about done. Maybe throw some paint on the cabinets that are already there usually. Do you suggest a certain price range for their first?
Yeah,
flip?
I mean,
like below a certain repair number, or
I would say stay in. I mean, this is, unless you're really experienced, this is for a general comment, don't go into luxury unless you have a really good construction background, a lot of liquidity, and a lot of experience, a lot of capital. But I would say $300,000 home is probably plus or minus. I mean, the average home price in Houston now is $400,000. That was just a recent high that we hit. I saw that on Houston Chronicle or something. But
I thought, wow.
yeah, average and median are two different things. I'm guessing median's probably a little lower. There's probably some big ones that are pulling that up. It's usually the way it works, which means half above and half below. That's the median. And I'd have to look back and see what that area covers. I think that was greater Houston area. But I would say lower end and more cosmetic. So stay away from moving walls, stay away from big foundation issues, redoing wiring and electrical, redoing plumbing, I would stay away from that as a first-time flipper. First of all, it's also just coordinating all that stuff makes hard. When you're doing that stuff, you're pulling out drywall, you're redoing insulation, and it just becomes a more complex job. So I would stick to cosmetic flips if I was, and then bridge. Like roof is not really cosmetic, but that's an easier one. That's usually a 1 or 2 day job.
Yep.
It's less dependent upon
The beginning.
the other stuff that you're doing.
Okay.
Because when you start ripping out walls and moving walls and adding on and redoing electrical, all those things play into other contractors' work.
Okay.
And your chances of blowing your budget go through the roof.
I would agree with that. I would agree with that. And
Plus, you're pulling stuff back. You're gonna find stuff. You're like that.
Yeah, I have one project right now that really I'm just kicking myself. I mean, it was my fault, and it's the older, in my opinion. I have a understanding that the older the property, the higher likelihood of your rehab budget getting blown out is, and the higher the risk of the project, the older the property. So like this property is like 1940 or something.
Yeah, so it's like an old Heights home or like.
I wish it was in the Heights.
Yeah. Well, then your land cost would be like $500,000, but depending on where you're at. But no, I get it. I mean, you see that in these old, especially the pier and beam style, because those are the ones that are built in 1932, and there's a lot of rotten stuff in there. So yeah, those are older the worse with respect to that. But also you can get better deals there sometimes.
Yes,
But that's not for, don't go for the home run the first time. Like, learn the business before you really step it up is kind of my thought.
Okay. Yeah, it's always tough to balance. Like, is it more risky the bigger the project or the lower the LTV? Because, we could talk about this all day. But I do have one interesting question. Okay, so let's say my friend Lacey, my friend Lacey, she wants to do a private loan to a real estate investor, such as myself, or such as Keith, or whoever, or say just somebody she knows. What advice do you have for a first-time lender that's lending on a property to an investor?
Well, I mean, the first thing is they have to do their diligence on the property, right? And then secondly, you need to probably hire, if you don't know anything about docs, don't download it off the internet. Find an attorney to run docs for you, because I'll give a generic example of something with a friend of mine. No names mentioned, of course. Entered into deals with a large luxury home builder and used the flipper's doc or the builder's docs, and didn't come with a personal guarantee, didn't come with some of the protections to a lender, i.e. maturity dates, that sort of thing. And basically the only way to put him in default is he missed a payment, which he took on too much, very speculative, and he also didn't file the deed of trust, which means that he could go do a bunch of other loans there on the property and other people weren't seeing them. And so he was basically using his speculative, massive home builds, like super luxury home builds, to fund a lifestyle. So unless I would hire an attorney to do my docs for me, and someone
To file the paperwork.
well, to do it all. But you need someone who don't go to the, the divorce attorney. You need someone who has a little bit of real estate background.
What about the title company? I mean,
Oh yeah, I absolutely go through title, but I don't know if I don't know if I'd use title to run my docs. I don't, because whose side are they on? I don't know, but that's the way I would do it. If you don't do that, there are some bad people in this business, like total fraudsters. I could talk about stories for days. And the funny thing is, my competitors, who some of the big names in town, know the same guys, and they'll bounce around, and they all have a story about so and so. I won't say the names online, but we talk. We will talk if we see each other at events, and some of us have history together with other things, and so if you're a first-time lender and you're trying to get in the business and do a little bit of side hustle action, there's a good chance you might get one of these people. And the other thing is,
Okay.
charge market rate. It's market risk. Don't, you probably don't want to hear this as a flipper, but like, why try to undercut the market? It means you're taking more risk than you're getting paid for. And this whole business is about risk. Anytime you're investing, it's about risk-adjusted returns. If I take more risk, I should take a lot more. If I take more risk, I should get compensated for it.
Okay. Yeah, I would agree with that. So what I hear is make sure this property actually has the value this person is saying. I have I have a lender, my friend Ethan, he does a couple different things, but he'll have, I think on one person he works with, they'll be like, because he does some loans himself, some loans with partners or whatever, and
Yep.
one of them will they'll order a BPO or something.
Yeah, I mean, I would definitely, especially if you're inexperienced, order an appraisal, an ARV appraisal. You have to go find an appraiser to do that, or a BPO. I don't like BPOs
Which
because
is broker price.
because you never. Appraisals can be this way too. I feel like they're a little more accurate, but BPOs are typically desktop.
Yeah.
And don't.
Very general.
Very general. I'm not sure they always really pick up the rehab.
Yeah.
Come back in 24 hours type of thing. And,
Yeah.
I've seen them where they're just totally, full of it. And I've seen them where they're on both sides of the spectrum.
Okay.
And that doesn't really help you as a lender. So you
Okay.
want to know what you're lending. And it doesn't help you be competitive. I mean, if you send me a deal and I get a BPO and you think the ARV's 200 and the BPO comes back at 100, my loan's not going to be that competitive for you, because the amount I give you is going to be way lower than what you're expecting.
Okay. All right. Well, I guess that's a little bit of the basics. You make sure the paperwork's done right, that you're not working with a fraudster. We said that.
I mean, you got to know the repair, you got to know the ARV, you got to know the paperwork, all that stuff you can get help on. Make sure the guy's got money in the deal, and then I think those are the big ones actually. Probably missing something, but.
Okay. Well, what do you think about in terms of in 2022?
Okay.
How are you? Well, first off, I guess a two-part question. Wherever you want to go, how are you limiting your risk, and/or you want to talk about this the whole
Affordability concept. Yeah.
Concept. Yeah. What you think about that?
Yeah. So I would say Longleaf is just like most lenders are being a little more cautious now. We've seen it just generally in the market amongst private lenders, hard money lenders, bridge lenders, all the same thing. Whatever you want to call it, whether it be a lending home, national, 800-pound gorilla, or smaller guys, especially national guys, they are taking less risk right now, and you've seen it. And so their rates have gone up, underwriting standards have gone up. A lot of the note buyers are on pause right now. So some people, brokers especially, we don't broker loans on the hard money side. It's all our capital, but brokers sometimes will sell their note to like a national person or a pool of buyers sort of thing.
Okay.
And a lot of those guys have stopped buying.
Okay.
Or stopped buying notes. And so as far as protection, I mean, what do lenders do? They reduce their LTVs. They slow down the process. They make sure that buyers have more cash in the deal, and they become a little more selective. So we're actually starting to see, I think our deal flow is slowing down a little bit, and there's a seasonality and cyclicality to this business, right? Right now, historically, what I've seen over the last 5 or 6 years is in the middle of summer, we're close to that, it slows down, and that's because if you're going to sell your home that you inherited or have, I'm going to give a especially in the summertime, I'm going to give it a go at the retail market, especially when it's hot. I.e. the market's hot. The market's still very strong. It's just starting to trend the other way. And then in the fall, buying picks back up. And the other reason why I think we see more buying in the fall than in the summer, in the heat of the summer, is because that sets them up for the next summer sales cycle. Like, more homes are sold in the summer and the winter, and it's because of schools. It's because people want to move and be in their neighborhood by the time ready so their kids can go to school, typically, right? So reducing LTVs, putting more money in the deal, being a little more cautious around ARVs. I mean, I have no idea where this market settles out on ARV, and no crystal ball, but that's the kind of the things we're doing to protect ourselves, maybe reducing the length of the loan. There's all sorts of things that lenders can do to give themselves a little more protection in times of uncertainty.
Okay. Interesting.
Affordability, sorry. Yeah, so I saw a post on LinkedIn not too long ago, and just compare what you could afford based on today's prices, and I kind of ran the same math based on a Houston purchase price. And so the average home price in Houston, I've already said it, is roughly $400,000. About 6 months ago, if you did the typical 30-year loan, 20% down, so you have a $320,000 purchase or $320,000 loan, that payment, not counting insurance and taxes, property taxes, at an average rate of 3.54%, that was the average rate in February, was $1,444. Okay, so $1,444 for a $400,000 home with $320,000 note. Today, that average rate's 5.25%. Still very low interest rates historically, but the same mortgage is $1,767, so an extra $300. But that also so that decreases your affordability. Plus, you have the other headwinds of 10% plus 10-ish% inflation, and that hits your utility bill, your gas bill, your grocery bill, restaurants, all that sort of stuff. So, said another way, if you could afford a $400,000 home with back in February with a $1,444 payment, now that home, what you can afford is $325,000 to make the payment basically the same. It's a big difference. As a flipper, expecting a $400,000 ARV, and now it's $325,000. Pretty sure you're underwater on that deal, most likely. So, if they continue to rise, and it doesn't mean people won't stretch a little more and that everybody's buying to the last dollar, because most people, I hope, don't buy to the last dollar, but it does affect affordability. And it wasn't long ago, like if you look back and if you look at the prime rate over the course of the last 10 years, it's been extremely low, but go look from 2000 to 2008 or 9, prime went up, maxed out, I believe, at 8.75. Prime right now is 4.25. And all those rates are kind of tied together. They're all based off the federal funds rate, which was 0 during COVID, and now it's kicked up a little bit. I don't know the rate off the top of my head, but it's easily Googled. So it plays into affordability.
Okay. Tell me about a very controversial topic here. I was telling you that I was speaking to my friend who is a lender the other day, and I was talking about jumbo loans, and then the conversation kind of came up that most of these people that have jumbo loans are getting adjustable rate mortgages, and the people that are buying a $200,000 house are trying to get the lowest rate, or trying to use 30-year mortgages. What are these people that get the jumbo loans that have higher net worths, they're more financially successful? than people that are getting fixed interest rates. What do they know that we don't know?
So why does I have an adjustable rate mortgage.
Yeah.
It's a 10-year ARM, and it's got caps on the back end, which means the rate can only go up so much. I think it's 2%. I'm in it 6 years now, or a little bit over 6. I go about 3.5 years, 3 to 4 years to fix it again. But and I think they're a great product. I really do. I think the 30-year fixed rate is an overrated product. It sounds awesome, but why? Because, and I haven't fact-checked this, but I was told by a mortgage lender that the average loan on a house lasts 8 years.
Yes. Yeah. People move every 7.
So, or they refi, right?
Okay.
It's a move or a refi.
Okay.
And so you don't need, and so this kind of goes back, well, another topic, if you're buying rental properties, don't be afraid of the adjustable rate mortgage if you can get it to lower your cost. But in my case, I probably won't be in my home 30 years. You know, at some point, I have 2 young kids. We'll downsize once they're gone, and they're 7 and 5, so they'll be gone in, you know, at least 13 years or so.
They're moving out at 7?
18. At 18. At 18, they'll be out-ish. And so I won't need, I live in a larger home, 4,000 square feet. I won't need that much space. I don't need that much space now. So why do I need a 30-year mortgage? I'm not going to be there 30 years. And that's the average person. So I can get lower cost of finance for a shorter term. Or, and also, like, when that 10 years up, I'll have paid down a decent portion of the mortgage. And so I can refi on a lower note, even though the rate might be up, the payment might be somewhat similar. And I have caps in place so that it just doesn't go from, if we're in an 80s or some 90s type environment where people are paying 12%, and so that's the really, you know, I'm not saying, I don't think we'll ever get back to that, but, or a 15% mortgage, like some of our parents paid. I do have some caps in place that protect me from it going from 3% to 14% a year, which would be a massive increase in the note. And that also gives me time to refi it. You know, I've been playing the game, like, when do I refi? When I refi, I looked, I could never beat my rate during the COVID era. So I said, well, we've got 3.5 more years left. We'll have a recession. Most likely we're probably in one. And, you know, the government, both sides like to buy the vote from time to time, and some of that is through interest rates. So I think the 30-year fix is it's a good product, but it's not the end all be all. There's other ways to do it that are cheaper, and the probability says you're going to be out of that property or have refied it anyway. I mean, if you think about it from a rental property perspective, and I have rentals and I've owned several renters over the years, I probably don't want to own a rental property for 30 years unless it's like prime location, and prime location is going to cost you a lot of money, right? So, and why do I want to own 30 years? One, it's going to degrade over time, but even if I do, it's going to pay down over those years, and it's probably going to increase in value, and one day I'm going to say I want to take money out of it,
Okay.
right? So I'm going to refi it before the end of the 30 years anyway, and take money out so I can go invest in another project.
But I guess, and then, but you think about capital differently than the average person does, because the average person is like, man, I want to get my personal residence paid off. I want to own a cat, or I don't want to have any mortgages. I don't, I want my rental. I'll start making. I've heard before. There's a lot of people actually that say, man, if I can get 10 rental properties paid off, like, then I'll live my best life. Or whatever.
Well, and each person has a different risk tolerance, so I think that goes into it. My mother-in-law and father-in-law have been in real estate, and they have a very different approach, but they're also in their harvesting years. I'm 43 years old. I'm not ready to go into blow-down mode and just harvest cash or harvest my investments. I want to continue to grow. And so back to the home loan and paying it off, when you think about in this state, in Texas, we pay 2.5% or up to 3% typically on our property taxes. We still have all those bills. You're not living rent-free. It's lower. But when I can borrow...
It's still going to cost you something.
when I can borrow, exactly, and life's never going to be free, right? So, but if I can borrow against my home at 3%,
and make a higher amount elsewhere.
and you know, if you think, well, I mean, most
I mean,
people.
if you want to offer us a loan at 5%, I'll go ahead and take it.
Well,
right
I'd be
now.
losing money because inflation's at 10. You know, if I can borrow, for example, if you own a house and you own cash right now, and you're borrowing from me at, you know, low double-digit rates, why not take a loan on that? Get your say it's a $400,000 house, you get $300,000 in cash, and go flip homes with that versus borrowing from me. Right? It's debt. You know.
Depends on what you get.
But and the reality is your home has more protection than the flip home. So if things go bad, and the homeowner lender is going to take a lot longer to, if you run into an issue.
Foreclose.
Yeah, you have higher rights, or you have better rights as a homestead. That's why most private lenders or money lenders won't do homesteads.
It's the foreclosure process.
It's longer, you have more rights, right? So, especially in a bankruptcy scenario. So, you know, I'm all about, from a financial perspective, using your cheapest cost of funds, and so that typically is your house or your car, but that doesn't really give you anything. But you know, if you think of where rates are on all those different products, so yeah, you know, why pay it down when the reality is right now with the way inflation is, and probably over the last 20, 30 years, your home mortgage at 3 and 4% is basically free money.
Yeah,
it is.
I would agree. I would agree with that statement.
So take
everybody thinks different.
But look, if I'm 60 years old, I'm in a totally different position. I'm paying down debts.
I like the debt that I'm not paying for.
Well, it's like a rental loan,
like a rental loan.
Yeah.
I'm trying to. What my plan is less properties vacant with payments, and basically analyze longer hold times. Analyze longer hold. It could be longer hold times. But keep.
Yeah. No. That's really it. See, what you're saying is no vacancies, of course, right? But paying down the debt and have fewer properties versus having a bunch that are all levered up with debt.
That are sitting vacant.
Well, yeah, and vacancy really shouldn't be an issue for the most part here now. You know, if you have a good product at a good price, it'll rent pretty quick.
Yeah.
That won't always. This is a market, just like every other market. It adjusts, and if you get overbuilding, I have had properties, and not in Houston, rental properties that took a hit on rental prices. We haven't seen a lot of hit on rental prices in this state, or since I've been here in Houston in 2011. Rental prices are generally pretty stable, very stable. Rarely go down here, but it doesn't mean, you know, like I'm sure Detroit had a different.
Yeah.
You know, it's all supply and demand,
I
right?
heard they're not going to come back over them.
Oh well, when
With
stuff gets,
with affordability,
that's it,
et
right?
cetera.
It's just the reason why people are moving from California, New York, and places like that here is because it's affordable. One of the reasons, and also companies are moving here too because of laws and more favorable. I mean, Caterpillar's is moving from, I believe, Detroit to Dallas just last week. You know, just announced that move last week, and that's several people. I mean, you've seen Tesla, you've seen Compaq coming back. You know, seen a lot of that come back to the Houston, Austin, Dallas areas just because it's so much cheaper, and the laws are more business friendly. So, which is one of the tailwinds, if you will, to the state of Texas. But doesn't mean it can't go the other way, because it will. If
For sure.
you know.
What in general, like in a market like this, I really think there's a good little niche in there around the 500 price point with properties. We should be doing very well on this one. We bought in Galleria for like 260 purchase. We got an appraisal for 500 like 3 months ago, or 2 months ago maybe.
How much you putting in?
Putting in 80. Yeah, so 260 purchase, 80K rehab. We'll sell for like maybe 530 probably.
Yeah, that's great. I mean, I think that middle strike zone is the, you can't make any money renting those type of properties. You just can't do it. It's
Yeah.
very hard.
Yeah.
And because most of those people who would rent that can afford to buy, have the credit to buy, the down payment to buy, but those seem to be the better property, in that kind of
Second
middle
home
income,
buyer, maybe?
middle income, yeah, second home buyer are the properties that seem to go, you don't face the person. On the low end, you get the FHA 3% people, maybe multiple appraisals, all sorts of rules around that. On the higher end, they maybe have a little bit more money, and when I say higher end, I mean a little bit above that 300,000 to 500,000. It's so higher credit quality, maybe a little bit more money for the down payment if the interest rate goes up, and then your financing addendum doesn't go through, or allows them to back out of the contract. And then on the high end, it's just such a more narrow buyer pool. And they're also, those people are looking at the people in the high end are also more, I think, they'll look at what their stock portfolio does that day, and that'll affect what they do. They're business owners. So they're just a little more conservative in general. If their portfolio is down 20% in the market, they're a little more conservative because they just got burned from, however many hundreds of thousands of dollars.
Like, hey, maybe I need to have more reserves for my business now.
Exactly.
In case something happens, maybe I shouldn't go buy myself a personal multi-million-dollar house or
Correct.
something. Okay, that makes
And there's
sense.
just way fewer buyers up there.
That makes sense.
Um,
What do you think about, and maybe we can argue here. What do you think about the location of these doing deals for the risk in like this time in the market? Like,
So-
I know I've personally seen that you've kind of been, wanting to tell me, hey, like, stop buying a little farther out in certain areas. And
Well, I think that generally speaking, the further out you go, the more risk there is. There's fewer buyers, right? So you should demand a higher. You should. I mean,
I
if
think
you're,
I think it depends on what area this is.
of course, everything's
What
location.
area of, I think there's rural, well, if you're 100%, it's 100% rural, there's no population.
Yeah.
but-
No, I mean,
I'll
I
let
agree
you
with you, but
speak to
I
this.
agree with you on that perspective. It's always going to be based on where the area is. But generally speaking, the closer you get to the core of a city, the more stable those values are.
Those repeat buyers.
Yeah, more people want to be there, right? And so it creates some stability. The further you get out, fewer buyers, and likely have, run into bigger issues there. But, I haven't.
COVID, it turned on its head.
Yeah, but for the last, 100+ years, the trends have all been moving to cities because we don't farm. The family farm is less of a thing today than it was when our grandparents were alive. They were farmers. Had 8 kids, lived way out in the sticks, and that's how they made their living. Or they had another job and they farmed on the side as their side hustle, if you will. But the trends have been moving to cities. COVID, there was a brief period, but the good jobs are in the cities.
That's where higher appreciation usually
The poverty is in the
is.
rural, right? And bulk, there is some inner city stuff, but like lower education levels, all that stuff. The good stuff's generally in the cities, for the most part. I mean, talking macro, not one particular area.
Mm-hmm.
And so it just, if you're up in Montgomery County, that's good area, good school districts.
That's
the
what I
thing.
was about to-
Yeah.
that's what I was about
So
to say,
I'm a big. I didn't quite understand this when I first got into real estate, but now I do, and I always look, especially when I'm comping houses, at school districts. I have a 7-year-old who's going into 2nd grade. She's my oldest. Didn't think about that when I bought my house. I was going to an okay school. We're not in that school. We're in a different school. We lottoed in to a different public school. But Mama always looks at that. We did a deal in Meyerland area. And the realtor, this buyer was using a realtor to purchase, first-time buyer. The realtor also was the contractor's wife. And I looked at it. First, my loan officer called me and goes, man, the comp tool we're using is like, I'm not getting that value. And And he goes, can you take a look at it? He was one of my guys in Austin. And so I started looking at it, and I'm like, well, yeah, the comps are like a mile away that they sent us.
Okay.
And so there's a good chance it's not the same neighborhood. It's a big neighborhood, so they were in the same neighborhood, but different section. And then so I scrolled down the listings and I looked, and the comps were in a 5-star school district or school zone. And, I think school rating sometimes a little overrated, but mama doesn't think that typically, or parents don't think that all the time. And then I looked in where our house was that we were doing, and it was 2-star. It's a big difference, and you could see it in the values. And so we ended up doing the deal. We just adjusted some things to make the deal work for us, and they're going to take more of the risk than they normally would have taken.
Okay.
But schools in Montgomery County, back to Montgomery County, generally thought of good schools, are a good school district, strong values up there, all that sort of thing. And that's why I know you're a big Montgomery County fan. I've seen your post on it. And it's not all rural, right? There's a lot of people up there.
I follow the data, Pete.
Yeah.
The data says this county is where it's happening.
It is. I mean, it's going.
Or where, it's blowing up at a faster rate than Harris County.
Yeah, well,
it's small. It is smaller.
Well, the thing, part of it is you've got the denominator effect, right? Harris County, I'm sure, has more population and less dirt, usable dirt. And so it's got to go somewhere, and affordability is up there, and you don't in this town, you don't have as much flooding and hurricane risk up there for the most part, unless you're next to the Trinity River, whatever rivers that run through there. But you're further away from the windstorm stuff that you get on the south side of town, right? And the flooding risk largely is, I believe, more on the south side of town. And Katie's pretty huge already, and it's also honestly probably the prettiest part of town.
Yeah.
Taller trees, all that sort of stuff.
Sure. Yeah. I want to tell you a couple opinions. See what you think about them. Give me your constructive criticism, Pete. Definitely go ahead and give it to me.
I'm not opposed to doing that.
My personal opinion is this house in Katy that we're buying. I think you're mentally delusional if you think the prices in Katy for homes could go down 20% overnight.
None of this stuff happens.
I think the houses in Katy, the worst case scenario is a small pullback in prices in Katy. We're not talking about the whole area.
Gotcha.
But considering good school district, good area,
they'll hold up better. That'll hold up better.
Yeah, I think in all reality we'll just see a slowdown in appreciation, in my opinion, in somewhere like Katy. But I don't think the values are going to go anywhere. What do you think about that statement?
It's a very specific area.
Okay, and let's say also in this, we're talking about a $300,000 house or something there.
Yeah, I mean, anytime you get, who knows? I really, like I said at the beginning, if I knew what the market, I probably wouldn't run my mouth about it, because I'd probably try to play some of it one way or the other, right?
Yeah.
It's like someone trying to tell you where oil and gas prices are going.
Yeah.
It's hard.
You can just make, at any point in time, you can only make the best decisions.
You can do
with
some
all the
analysis.
information you have, all the information you have available to you.
Katie's a great suburb. Ton of people out there. You're close to the energy corridor. It's a hell of a commute if you're coming downtown, and spend a lot of time there in your car. But there's great schools out there, and all that stuff is going to keep things. But if you think about private markets, people just hold on. Like if you were in a house in Katy right now and you wanted to move up, but now you want to move from a 300 to a 500, you might just say, you know what, I don't really need that.
So there's always going to be low inventory in places like.
Oh, people just hold on
good
longer.
Neighborhoods in Cypress, good neighborhoods in Katy.
Yep.
Okay,
I wouldn't say always low inventory, because always is a pretty strong statement,
You're right.
But
most of the time,
people will hold longer. They'll just and so that means fewer buyers, and it can do that, right?
All right, roast me on my next deal, Pete. Purchasing a property. I've done some other analysis, and I came to a conclusion that Grimes County is an incredible county that has across the county. Grimes County has very low days on market, and the land sales are super quick there, and the home sales. In every market, people want different things, right? So in this county, people want at least an acre. And so, are you gonna look where Grimes County is?
I know where it is, generally speaking, but
it's between here. It's near Navasota, between here and College Station.
Yeah, that's what I figured.
So Navasota. And Navasota's pretty, like, it has the rolling
Yeah,
hills.
it is pretty.
There's
That
a lot
little
to do.
Highway 6 in there is nice. It's
Yeah.
got some topography, which we don't have here, so you don't see as
Yeah.
many strip malls and all that kind of stuff.
And I think in those areas, people want a certain product. They want, and it depends on the buyer, right, and the price point. But really, they want over an acre or two. But then if you start getting too many acres, then you make it unaffordable.
Yep.
So we have a property. We're buying it for about $240. I think it's a little less than $240. Buying it for $240. It's a 2002 build on slab.
So it's pretty good condition. Maybe need an AC or roof.
2,800 square foot. It does need we need to go in there. We need to do a full bathroom remodels, AC, roof's good. We're gonna do a full remodel, new windows. Because I think the best product, best price is gonna be important for hold times and stuff like that. And the house next door just sold for $733. This has I'm sorry, I need to tell you the lot size as well.
Yeah, 'cause that's
This
big.
also has 5.5 acres. It has a pond, a small pond in the property, 5.5 acres. It's a single family house. We described buying it for around $230, $240. Keep in mind on some of these acreage properties, you have to run a good landscaping budget. So it's going to be a significant amount of landscaping. The dumpsters are going to cost an arm and a leg, bringing all these dumpsters out there. We're going to have to pay all our guys more gas money to get out there. So that's a thing you got to think about. We're going to spend probably around $100,000 on
the remodel, and that
Yeah.
includes the landscaping.
Yeah, about
Okay.
100,000.
So buying 230-ish.
So yeah, 230, 240, 100,000
So you're in for 340, yeah.
And then the ARV is 500. I like that price range. I think 5.5 acres, a pond, a fully remodeled property will sell pretty good in that price range. I don't think it's a big risk. The days on market are super low. House next door is 5.5 acres as well with a pond. This property was pretty good shape. It had a tin roof as well, just like ours. This property had a pool. We don't have a pool. This property had an additional very large shop, this very expensive shop on the property. It just sold next door quickly for $733.
So it sounds like it's a pretty good comp minus the pool and the shop. The shop, I don't know how.
There's another one that sold.
The pool is probably 70 to 100 replacement cost, but
Okay.
you don't get full value on a pool, although it makes your house more desirable.
For sure.
And
There's another comp that sold for $470, fully remodeled, similar lot size, fully updated. $470 sold like 6 months ago, 5 months ago maybe. And this area's low days on market. It's considered rural. It's considered rural. It's not in the city. Most lenders said no, we won't lend on it because it's rural. It's a 15-minute drive to Huntsville, or approximately 17-minute drive to College Station, and
17 minute?
about 18 minutes to College Station.
Okay, but it's not in like
This is rural.
schools.
No, it's rural schools.
Okay.
And then you come to Houston and it's like
An hour.
55 minutes probably, an hour. And the agents over there are like, wow, people will love this. This is
Sounds like you've got
cream of the crop for rural.
You've got a pretty good margin built in there.
And so we're calculating after, I think it's okay to say this on the podcast.
Your
We're
profitability?
calculating a pretty good profit there. I think you know what kind of numbers we're.
Yeah, you said 540 with a 340 cost before holding cost and.
I'm calculating I want to stay conservative. You told me to stay conservative.
So 500,000 on ARV, 340 all in, less lending.
Yeah.
Less
The
holding.
loan's gonna be for the loan's gonna be for 330. I think about 330.
Yeah, I mean it sounds like I don't know the area, so it's very hard to comment. But based on the numbers and how you've comped it, and it sounds like you're down. I mean, depending on market, but it does sound like you've got a lot of.
Some data.
A low, your floor is pretty high, so it doesn't sound like you're gonna lose money on the project, and I always tell my borrowers
What's
like,
the worst case, or?
look at the worst case and don't you're gonna lose money on some projects if you're in this business long enough. It's gonna happen. The market's gonna change on you. You're gonna pull something back and be like, oh, whatever, and I have to do a lot more of this project, or maybe you took on too much, stuff that's going to slow down, and you can't manage it all, because managing the contractor, especially when you're all spread out like Houston, can be a challenge. But if I would never go into and thinking that like I have a high probability of making zero, because you're not in this business to flip homes, you're in this business to make money, right? There are people that
For sure.
get in there because they want to flip, but you shouldn't be bragging about how many homes you flip. You should be bragging about how much money you've made collectively minus the ones you lose on. And so if you're bragging about it, I actually would say don't brag about it, because that just creates competition. But it sounds like your downside's pretty protected. And you're getting rewarded for going to a rural area, meaning that your margin is higher than if you were in the city, and that compensates you for the extra driving, the fewer buyer risk, right?
Okay.
And so I just say, like, and I've said it at least once, get paid for the risk you're taking.
Okay.
The more risk you're taking,
Get paid for the risk you're taking.
the more risk you're taking, the more you should get paid.
Do you think that relates across asset classes? So
Every
say if you're
asset,
doing
anything
say
you're
if you're
investing.
buying a commercial property and it's 50% vacant. that
Absolutely.
that you should be buying at a bigger discount. So once
Absolutely.
you stabilize that property, there's more juice in the squeeze. Or,
Absolutely. Absolutely. The cap rate should be higher on a vacant property versus because you're the one. Why would you pay for? You're the one doing the work to get it listed, right?
I don't like to work for free.
Exactly. So you should always get paid for risk. And that's real estate. That's buying Walmart stock, Apple stock, speculative stock, any asset class, anything you're investing in, you should get paid for risk.
Okay.
So more risk, more return, less risk, less return. That's why cosmetic flip is usually going to be a tighter margin, but not always. But there's anyone going to a weekend class can line up a painter to paint the place and sell it, right? So the margin should be lower because it's an easy flip. If you got to tear down walls, add on, that sort of stuff, you should get paid more. Also, you're going to be holding that thing longer.
Yeah.
But that's just the nature of. That's the way it should work out. Now there are deals, and Keith had a deal not too long ago. I think he said this. He put $5,000 into it, made a ton of money, and was sold it in like 2 months from the time he purchased it, which is kind of unheard of.
There's always
But those are home runs, and like you shouldn't. I mean, you can't bank on home runs, or you're never
you have
going
to be in the game.
Exactly.
You have to be in the
Game to get a home
You have
run.
to be going to ever get those ones. Yeah. Where
Yep.
it's home run, I feel like. So I want to stay in the market regardless of what it's doing, but you want to be safe.
Yeah. Well, look, the
run
good
more
news
than
is right
possible.
now, if you're a little more bearish on it and that plays out, and you have the liquidity, maybe there's going to be people in this business that get flushed out. They lost a bunch of money, had to turn their properties over back to their lenders, whatever the case is, weren't that good to begin with, who drive your margins down. Or people like you and Keith who've done this a decent amount of time, have taken your hickeys, also made a bunch of money, and have learned from your mistakes. The down market, those markets, if you're liquid, is you can make tons of money. Example, 2012, ask most of the hard money guys in this town who were also investors at some point, and still are, in real estate. We were buying properties. When I got here in 2011, I started buying in 2012 foreclosure properties from the net worths, the New Westerns. And you'd buy them, I'd refinance them, get into a longer term note.
You built up a lot of net worth during that period?
Yeah, if I had known what I know now, I'd have taken more hard money debt and bought everything. But that's always hindsight, right? But there was a property I did on Randon Road. It's north of 290, a little bit west of Oak Forest, off of like 43rd, whatever that turns into. And I think I can't remember what he bought. Oh, $40,000. This was like 10 years ago.
They're here for you. I'm messing with you.
We bought it for like $40,000. We used Fast Track to remodel it. Cost us about $30,000. And then it turned around and praised, so I'm in for like $70,000. Prayed for low 100s. I got all my money out of the deal and was still cash flowing $600 a month. My note was like, I think my note was like 6.5% around that. That's where rates were then at the
But
time.
you were making
$600 on $0 in, and just about had one. And
return.
it is, and I'd pass at deals that today you'd think are a home run on the rental side, right? And so those will come back as people leave the market, as rental rates increase, as property values decrease. But right now, it just doesn't generally speaking, doesn't work out that well in a single family. But I had, a dozen of those at a time like that at one point, and I've sold them off. And another one I have I have my last rental property. I have one left. Eagles Glide. I bought it from New Western for $65. I put about $10, and I put money in along the way. It's worth $190 now. Levered return, infinite. No equity in it. At one point, I'm down. I have equity in it, cash equity, excuse me. But play all sides of the market and stick with it and be conservative when the market's super hot. It's the whole Warren Buffett saying,
Be fearful when others are greedy.
And greedy when others are fearful. But you got to do your math. You got to know what your downside is, and then if you can pick up some really good assets for the long term in downturns, then you can have that cash flow that sustains you when you don't have things. So, I'm not hoping for a downturn by any means, but it would create a lot of opportunities for people like yourself.
What's the first ball that falls to where like the lending starts tightening up? Are all these hard money lenders, are they still going to be around?
Some won't. Some won't.
Am I gonna?
And I hope
I
hope I'm still around. But
do we need to be worried about home equity lines of credit? What about bank lines of credit? Do we need to be like worried? Do you have any insights on how that constricting process happens, or any other tips than just have as much cash as possible?
Yeah. Don't sit on your inventory. If you've been in a house for right now, as far as on the market for a month, especially if it's a $300,000 house, everything is a function of price, right? So sell it, drop the price. I know you think you need to make 50 on it, take 40, because the reality is you're going to sit on it longer, and your debt's going to eat you away anyway, right? And your property tax bill and your utility, all that stuff, right? So that helps get, in this time, I'd say a little more liquid. But as far as your question about the market and people tightening up, you've already seen it. I'm seeing it, and the market, the debt markets, the stock markets all play into our market, and some people don't. There's this concept in real estate that you can't lose money when you're on holding properties and that sort of thing. And the reality is most people.
The side, and just to play the devil's advocate, the side of that coin says, hey, Pete, in all recessions, the price of real estate didn't always go down.
Correct.
That's that side of the coin, right?
Correct. But I guarantee you, if they jack those rates up to 10 or 12%, you're going to have real estate dropping in value. It doesn't mean you're going to lose money. And if you're a long-term guy, you're probably fine because, rates will go down again. But rates are still actually really affordable right now. But we're not. I heard a professor at NYU, or I went to grad school, say once that the market is the number one to determine your success. It's not you. Most people believe that when they win, it's because of them. And when they lose, it's because of the market. That's not really true. The market, by far, has the largest influence in your success.
Okay.
Right? And the market's pretty much is the same for everybody, right, for the most part.
Okay.
And so don't, back to the holding the houses too long. If you're in it, especially right now, drop the price, get out. Build your liquidity up. You can't do anything to affect the market. Nothing you can do. It's way too large. No one can really manipulate the market. OPEC may be to a certain extent, but most markets, Google could probably do the online market, but that's called more or less monopolistic power, right? And you and me are a little grain of sand on a large beach when it comes to that. So, when you see the signs, and the signs have been there for the last 4 months, and that's why the Feds raised their rates, 75 basis points a couple weeks ago.
Mm-hmm.
you know, that's the signals to, hey, we're at the tail end of a boom. We may level off, we may dip, we may slowly increase, but I don't have a crystal ball on that. I don't know what they're going to do. Most people think they're going to raise again, and all that will play into affordability. So look at all the signals and make what you think is the educated call, and continue to look at the signals until, you know, starts going the other way, and then, you know.
How important do you think it is investing in something you know, understand, and then I guess the last part would be like, we can, you know, actually touch what we're investing in. And is that why you got into this? Because you actually understand what you're
It's
investing
easy
in?
to,
As opposed to, like, for instance, right now, I want to, when I see the stock market down, I see, for instance, I see Harley Davidson stock down a lot right now, or some of these Bitcoin or some of these other stocks.
No, it's 100%.
I don't understand what's going on.
So don't touch it. If you don't understand it, don't touch it.
You know.
I think so. By way of background, I've taken companies public. I've done debt. I was an investment banker. I worked on Wall Street for 10 years. Prior to doing this, I have an MBA finance degree from NYU, which is a top finance school. I got it graduated in 2009. The stock market's a great vehicle, and it's not about picking an individual stock. It's about always being in market. You know, they say timing the market. First of all, it's very hard to time the market, and most people can't do it more than once, right? It's very difficult. It's very hard to beat the market too on returns. There's very few people who do it over the long run, for a variety of different reasons. So it's time in the market. I would say but back to your fundamental question, if you don't understand what you're investing in, don't do it. If you win, you've gotten lucky. If you lose, you know, maybe bad luck, but also and for me, I'll tell you some personal examples on the stock side.
Yeah.
You know, started buying Apple products probably the moment I graduated college in 2002. iPod was out.
Yeah.
I
remember those iPod Nano.
And then along the way, I had several. My sister actually bought a decent amount of stock in Apple because her boss had it in 2000. I won't get into the financials of it, but let's just say it was one of those ones that just a grand slam wouldn't be put it that way. You know, how well that stock has done over the years. But I've had a hard time when I value those stocks, and I can value a stock, but it's all based on, the inputs and what the assumptions around the inputs are. And I don't always understand that on the tech side of things, so I've stayed away from that and probably cost myself lots of money by not doing it, right?
Yeah.
Because I didn't understand, I couldn't get to the growth rate assumptions, which to go into the valuation. Mm-hmm. And I know I'm kind of diving down a rabbit hole here, but my point is, if you don't understand it, you shouldn't be in it. You're gonna leave it to someone who's professional, or like within a stock, if you're talking about stock market asset class, you index, right? You get the movements from the whole market, diversifies out the individual risk of Harley Davidson going bankrupt or them making events.
Like say this company Harley Davidson. So say I'm trying to decide if I want to invest in this stock. I know this isn't the main topic, but
but it plays to real estate.
I see the values are down a lot, right, for Harley Davidson, and
you see the stock prices.
I see the stock prices down.
That's a different from value.
I see they're making cash. I see they have reserves. Reserves for potential new marketing campaigns or whatever, but the bears are saying, hey,
people buy less bikes.
Less people like you, Ben, are going out and buying Harley Davidson
because of luxury products.
Because the generation that loved Harley Davidson is actually your dad, and
but
those people are leaving, and then also in a recession, probably when inflation comes, less people are probably willing to go out and buy a Harley Davidson.
Yeah, I don't know. I can't buy individual stocks due to my wife's profession, but without handing it over to an advisor who just picks them for me. And no one really beats the market. I can name like 10 investors who beat the market over a brief period, but then the market catches up to them. Meaning like famous dudes.
Like, does Warren Buffett beat the market, or? Like?
Yeah, as George Soros, people like that have, but eventually they get so big it gets harder because they have such many assets under management.
They can only buy a select amount of stocks.
Yeah, and they'll move the market themselves and all that sort of thing. So there are several different guys who've done it over many years, but you get too big. Your denominator gets too big, so you have to buy so much stuff that this weighs you down. But I can't speak to Harley Davidson, but what I can say is like if you don't understand all the inputs, you probably shouldn't be going for any real estate. And it's the same thing with real estate.
Is that why you got into real estate? Or just...
Well, it's easier. It's very for a short-term investment, and knowing there are some protections, a little bit more protections in real estate. It's leverageable. There's all sorts of things that you can do with it, but it's still like any other market. It goes up and down. What keeps it a little more stable is homeowners. If you buy a house, bought a house yesterday, and we are a year from now, and the prices are down, what are you going to do? If you can afford it, nothing. You're just going to stay in it and pay your note.
Mm-hmm.
So that it pushes a floor up in valuation across the real estate, residential especially, because residential is a mix between investors and homeowners. Investors, you see in the stock market, buy and sell stocks all day long, and that's why prices goes up and down, whereas real estate, same thing, but it's more level because people are living there. And if you bought a $400,000 house today, and a year from now it's $325,000, and you have a $320,000 note on it, but you can still afford it, you're probably not going to sell unless there's a catalyst for you to sell, meaning your job's pulling you out of town, you lost your job, you can't afford the house, and now you got to go to rental, you have to downsize, death in the family, whatever, right? But it provides some stability to the asset class. But it's also, if you don't have an investing background, it's one of the easier. It's a simple business to understand. I think it's not necessarily a simple business to perform because there's especially when you're flipping homes. There's all the operations and logistics of it.
A lot of like puzzle pieces. The concept is basic, but it's not. It's easy to get in. It's not easy to stay. There's a lot of ways to put it, right?
Yeah.
There's just the concept is simple, but there's a lot of moving parts maybe.
Yep.
That we put together. I know you said something else about about write down your goals. I love that. I actually have a screensaver.
Yeah, you asked me
on my
before
phone
this
with goals.
what a good flippers do, and one of the things I think people miss is, I think I mentioned it, is talk about how many flips they've done, all that sort of stuff, and that's good, but we're in this to make money. And
I've done 5,000 flips, and I own 50,000 doors.
Exactly, right? And that doesn't really
doors.
tell me anything other than you've done a lot of transactions. It doesn't tell me if you made money, lost money, which is what we're really doing this business for. But I think goal setting is extremely important. I have financial goals like I hope everybody does, but if you don't set tangible goals and write them down and work towards them, then it's just a dream. We can dream about winning the Powerball, but it's probably not going to happen, right? Yeah, so just write them down. And I also believe, like personally, I have a spreadsheet that kind of has, like net worth in there that I calculate it at least weekly.
You track your net worth weekly?
Yeah, I do.
That's a note that I took, I took down on the phone call the other day we had, where you were talking about just one thing I remember just was that you said you were tracking your net worth.
You know why I do it?
That's a lot more.
It's not that hard.
Business, like,
Yeah, it ties into liquidity.
Banking relationships.
It ties into a lot of different things. Liquidity, how I work with banks, all that sort of thing. But it also keeps me honest. So like I told you, I sold a lot of my rental properties. I had properties in College Station that I underwrote to a certain rent, and because the college was expanding so much, and when I bought it, they were X rent, and more and more development happened. It's a bunch of fields, right? You just go on forever there, it seems like, because it's just rural land outside of town. More and more stuff got built. The rents got crushed. I kind of alluded to that earlier. And so what did I do? I was like, okay, now I'm making a cash on cash return of like nothing, 7-8%, not including maintenance and that sort of stuff, which is small in a new property. But like, well, I got, X dollars, significant dollars, $50,000 or so in each one of these properties, and I'm returning nothing on it. And yet I have this goal. So what I do, I said, I need to sell the properties. It forces you to look at the performance of your assets and clip your losers, unless you project those things to do something else, right?
What's working, what's not, like what can you put to better use?
Yep. And so, and it also forces me to constantly look at my goals. That is kind of my goal spreadsheet, and it's numbers out in the future, and I base them based on returns and that sort of thing. And I think if you track something, you lift weights, you go to the gym a lot. I know you probably track your weight or how much you lift. And if you
calves,
you're measuring calves, right? And so if you're doing something that's not working, you're probably going to try something different, right?
Yeah, you don't know unless you're
measuring it,
measuring.
right? And so like, there's a reason why we've become so data focused over the last for decades, but even more so now with our better tools. We've been talking as society, because if you track, you do better, and you can figure out what you're losing and either reduce that loss and overall portfolio. So set the goals, whatever that is. I would say make them a little bit more, like, don't make them so easy, but don't make them so aspirational, and set long, medium, short-term goals, because there's the long-term goal sort of seem like they're forever away and impossible to reach, and it's easy to give up on those, and the short-term goals are the easiest to attack. If you think about when you have a big day of a lot of stuff to do, you're trying to get, if you have a list, you want to knock some stuff out, some of the stuff you can't get to, but the more you track that stuff, I think the better you do.
I like that, because I went to a Tom, do you know Tom Berry with ILS Lending?
Yeah, I don't know him, but I know the name. That's what, Net Worth's guy? Net Worth ILS, or is that, I may have think somebody else.
I'm not sure if that's who, if he endorses them or not.
Okay.
But I went to a little mastermind. I paid for a mastermind with him a while back, and it was like I think it was about a 5-year plan for your 5-year plan for your life. And so I have a plan that I really want to get to a personal net worth of $3 million, and he broke that basically.
How to get there?
Broke that back to where the first year you're not like, because the first year, if your net worth is
500,
whatever it is, then it's hard to see $3 million personal net worth.
No, that's why the short, the medium term, and how to get there.
Yeah,
like, it's not
it's
just
like,
the goals, but it's also like what becomes the plan to get there.
Yeah.
And so if you need to get to 500,000 and you average 50,000 a flip, average. I'm not saying you do, but you got to do 10, right?
Okay.
And then you got to continue to grow. And the great thing about net worth, what you'll find is, as you get closer to that, it starts to compound and it rolls. That's kind of time in the market, is what they call it in the stock market, versus time in the market, but it starts to roll, because now look, your returns may go down because your portfolio goes up, and it becomes harder to, if you're achieving 50% returns in the market or in flipping homes, you'll have to do a lot more homes, and maybe that comes at the expense of margin, because you'll have to hire a construction manager or whatever, but that's just part of it. But long-term goals, and then how do I get there is the next step, and then keeping that in mind daily. And I think that it all goes into discipline and that sort of stuff. Same stuff you do in the weight room.
So your advice to someone like me would just be like, you need to probably check it more often, have everything laid out. So say like you're Bob the business owner. Bob the business owner has this business, and this. Say it's 3 businesses. What's making you know how much each one's making you.
Yeah.
Should you sell off one business so you can go work harder in the other business?
Correct.
Or
absolutely.
Et cetera.
And I didn't start doing this until, like, it was not something I've done, and I don't always get it weekly. Sometimes I do it more than once weekly. But I try to do it weekly just to make sure I know where I am financially. It's really more, I want to know where I am financially for deals, and that drives it. But it's all one update, and more or less. So, but I found that I do better when I track it than when I don't track it. And also, the more complex you get, the harder it is to track stuff.
Mm-hmm.
So it also makes sure that I don't like lose sight of something. For example,
Does that make you keep things simple in your business too? Or
no, because it's harder when you get bigger, when you have more success. It's harder to get simplistic,
Okay.
right? Like if you look at someone, I don't know, you mentioned, Warren Buffett, which is obviously the way extreme, but he's going to have a massively complex tax return, right?
Oh,
Anyone
okay.
like that, right? Or any business owner that's in 4 or 5 different things, right? But it does, what it does is sometimes when I track, I'm like, whoa, what happened? Or wow, how did I get so much? It means something's wrong with the spreadsheet, or I forgot to do something. And that's another reason why I check it every week. But I forgot to put a loan in or something, and the money went out the account, and I'm looking, and I'm like, I'm X dollars poorer, or I'm X dollars richer,
Okay.
So.
Yeah, sometimes it's kind of like, I guess for a commercial property or residential property, you can look and be like, okay, this is the debt I have on it is $300,000 and it's worth approximately $500,000. So you're just gonna go ahead and put $200,000 for your net worth there.
Yeah, well, what I do for those, I generally take out the selling cost of it,
Okay.
if I'm being honest, right? But yeah, I mean, that's what I do. You have several properties. I don't know how you would account for them as they're flipping them, but like if you have residential rentals, I think you do.
Yeah, I do.
You put those in there, debt minus what it's worth minus the debt, or you can hold it at cost if you want to. I think it's important to be honest if those property values do fall to put it down. And just being honest with yourself about that stuff helps. But yeah, and then your cash and your cash accounts, and if you have stock, those stocks are easy to track because if you're on Fidelity or something, it tells you. But if you're in a lot of private stuff, this was when I really started doing. So I got in a lot of private stuff because if you have 20 homes, which I don't anymore, but I was up to that point at one point. I was seeing a ton relative to some investors. Tracking the performance of those, if I'm having problems with rent or maintenance or any of that kind of stuff, it kind of leads to you to clipping the bad ones.
So I did, and like with this whole, like the last couple of weeks, people have been like, oh, the market. So I did something kind of like that. So I went through each property that I have personally,
Mm-hmm.
or et cetera. So like I have this residential property, this commercial property, and then with this company I have all the flips. I went through all the flips, and I did like an approximate value of the property, approximately what the loan is.
Yep.
And we were with CHB. We're levered at it was 62% LTV.
Yeah, it's good.
And so whenever somebody was like, hey, I'm worried about this or I'm worried about that, I was like, well, we're at 62% LTV, so we have room if we had to lower prices. And then I guess for my net worth, I was like, okay, well, I'm going to take out some fees, right?
Yeah, of course.
And then I'm going to take out some holding costs, and I'm going to take out some taxes.
Yeah,
as
of
well.
course. Yep.
Is that so I took out taxes, holding costs, et cetera, and then divided with whatever business structure I have. Is that how you would add that to say my personal net worth?
Yeah, I would absolutely do that.
And then whatever cash accounts you have.
Cash account, stock account. I mean, I was applying for a loan once, and they asked me to fill out a personal financial statement, and you can download those things. And I've manipulated it. I've actually projected. I've added a really back of the envelope crude projection that includes what my wife's salary is. And so I can say, if I keep going at this rate in 2027 on October 2027, I can say I'll be worth this, right? It's garbage in, garbage out, whatever you assume is the rate that you're appreciating, but it does set some sort of expectation, and I go back and look at my projections versus what I thought I was going to make, because then it helps you make better decisions. So
appreciate you, Pete. Thank you very much.
Thanks for having me.